In this video, we have multipliers. This has to do with the concept that goes back to fiscal policy, which is something we discuss in relation to aggregate supply, aggregate demand. And the idea here is that when the government increases spending and or decreases taxes, it has a larger effect on the economy than the initial change in spending or the initial change in taxes. So for every $1 the government spends, it will have a bigger impact on GDP than just that $1. And if we cut taxes by $1, it will also have a bigger effect on GDP than that $1 cut in taxes. The idea here is that let's say the government increases spending by $1 billion and pays people to do something. Now those people have $1 billion, right? That $1 billion when they're paid to do something was $1 billion in GDP. And now they've got $1 billion. They go off and spend a chunk of it, most of it. And when they spend a big chunk of it, that is again more aggregate demand, more GDP. And whoever got that money will spend a big chunk of that, which is going to be more GDP, etc., etc. So it kind of ricochets around the economy and multiplies. And so we're looking at just what we mean by that and how we can calculate that. So there's a little bit of math involved, but the math isn't complicated. Just remember a couple of easy things and you'll be fine. On the AP macro test, remember they keep the math relatively simple, so you shouldn't even need a calculator. Alright, so in order to be able to get a handle on this, first of all, let's look at consumption and savings. If you're an individual, you can only do two things with your money. You can spend it or you can save it. It's one or the other. Any money you don't spend, you have therefore saved. Don't think of savings as merely being what you put into a savings account or invest in stocks or something. It's just money you didn't spend. So your disposable income is, I always mean to fix this, after takes. It's supposed to be taxes of takes, but same thing. Your disposable income is whatever money you have left over after taxes are taken away. Lots of times people think of disposable income as being your play money, all right? We can use for entertainment and stuff like that. No. It is anything after taxes, okay? Taxes you got to pay. You don't have a choice in the matter. You're compelled to. And the rest of the money, you can decide how you're going to wind up spending it. Okay, even something like your rent, you might think, well, I've got to pay my rent. Yes, but what kind of apartment do you have or house you have or whatever, right? You can determine that, which means you have some sort of ability to choose how you dispose of that income. All right, so disposable income is all the gross income, your overall income, after taxes are subtracted from it. All right, so you can do that stuff, blah, blah, blah. Consumption, we've already talked about this, right? Household spending, all this stuff, what it's constrained by, etc., etc. Can you consume if your disposable income is zero? You have no disposable income. The answer is yes. And the reason is that you could wind up dipping into existing savings, or you could borrow money and go into debt. Either way, you can still consume, even if your disposable income is zero. Sometimes this is called dis-savings, right? If you're going negative on this one. All right. Now, average propensity to consume. We're going to be looking at two terms here. One of them is average propensity to consume. Another one is marginal propensity to consume. We're going to look at average propensity to consume first. The APC. And what this is looking at is of your overall disposable income, how much of it do you spend? All right. Of your overall disposable income, how much of it do you spend? So the APC is equal to your consumption over your disposable income, right? C over DI. So I'm just going to keep going here. I don't like that example they had there. Let's say you had something like your disposable income was, I don't know, $100,000 and you spend $90,000 of it. All right, so that means you spend $90,000 out of $100,000. Your APC would be 0.9. All right, 90%, but we're going to express it as a decimal 0.9. Okay. Now, savings on the other side is anything that you don't spend again, right? So if you have any money, you're not spending it. That savings, can you save if you have no disposable income? The answer is no. You can spend if you have no disposable income, but you can't save if you have no disposable income. Okay, so the APS is your average propensity to save. Okay, so savings over disposable income. Let's say we look at our previous example. you spend $90,000 out of $100,000 in disposable income, so therefore you have saved $10,000 out of the $100,000, which would mean that your APS is 0.1, right, or 10% of disposable income, but again, we'll express it as decimal 0.1, all right? So determinants of consumption and savings, this is all the stuff that affects consumption overall. We talked about this in a previous video. All right, now this is important, and we see this with the marginal propensities also, is that APC and APS have to equal 1, all right? One way or another, they have to equal 1. So in our case, we had 90,000 and 10,000 out of 100,000 income. That gave us 0.9 and 0.1, which added together are equal to 1, all right? Even if, let's say that you're spending more than what you have, right? So let's say your average propensity to consume in our instance was 1.1. Let's say that you had disposable income of $100,000, but you're spending $110,000, all right? You were spending more than your disposable income because you're either borrowing money or you're dipping into savings. That can happen, but that means that your dis savings would be negative 0.1, right? So your APC would be 1.1, and your APS would be negative 0.1, right? Because you're spending $10,000 over your $100,000 disposable income. So that'd be negative 0.1. So the two added together come back down to 1 again, all right? So just remember that they got to equal 1. Okay, now the average propensity to consume, they might come up periodically in a question, but they're not the most important ones. The most important propensities are the marginal propensities to consume and to save, the MPC and the MPS. This is the one that we're going to wind up using for our calculations. Okay, again, disposable income, blah, blah, blah. Okay, now the MPC, where this changes is the MPC, instead of looking at how much of your overall disposable income do you spend, it's looking at how much do you spend out of additional disposable income that you get, all right? So let's say you already earn $100,000 and I give you another $10,000. What we're going to analyze here is what do you spend out of that additional $10,000 that I give you, all right? We're not concerned now about how much you spend out of the original $100,000 or what you spend out of the combined $100,000 and the new $10,000. So what you spend out of the $110,000. We're only concerned about what you're going to spend out of that additional $10,000 that I gave you, and what you will therefore save out of the additional $10,000 that I gave you. All right, this is what the MPC and the MPS are concerned with. Skip this guy. Actually, well, look at this now at the bottom. This is what the MPC is calculated as. It's the change of consumption divided by the change in disposable income. So in our example here, let's say the change in disposable income was $10,000. I gave you an additional $10,000, and out of that, you spend $8,000 of it. Okay? So your change of consumption was $8,000, and your change of consumption was $8,000. Your change in disposable income was $10,000. So therefore, your MPC is 0.8, right? 8,000 out of 10,000. See how this works? The MPS is your marginal propensity to save. So it is looking at out of the additional money that I give you, or that you receive in disposable income, how much of that do you save? So this will be the change in savings divided by the change in disposable income. Now, the example we just used, I gave you $10,000 additional dollars, you spent $8,000 of it, so therefore you saved $2,000 of it. All right? So you saved $2,000 out of $10,000. Change in savings was $2,000. Change in disposable income was $10,000. So therefore your MPS is 0.2. All right? Now, you'll notice here also the MPC and the MPS must equal 1. Now, once you've gotten 1, you already have the other one. So in our example, once we knew that the MPC was 0.8, we knew automatically that the MPS had to be 0.2. Okay? So just remember MPC and MPS have to equal 1, and you can do any calculations that come along with it. All right. Now, here's where we put this to use. First of all, we have the spending multiplier. This is the idea that if you have an increase spending on either consumption, investment, or government spending, you'll see a multiplier effect where the change in aggregate demand and the change in GDP will be greater than what that initial beginning change in spending was. You'll see this a lot of times in questions that concern increase or decrease government spending that involves fiscal policy somehow or another. All right? So an initial change in spending will cause an even larger change in that aggregate demand or GDP. Sometimes it'll say one or the other. All right? Okay, skip this part here. Okay, spending multiplier effect. All right, this is what we talked about, right? So the government spends money, people have it, they'll spend some of it, right? Then other people have that money, they'll spend some of that, etc., etc. All right. So an example here. Let's say the government increases defense spending by $1 billion. So they pay the defense contractors. That's GDP when the contractor got paid, right? And then the contractor pays the employees. That's GDP. And now the employees have money. They'll save some of it, and then they'll spend it on goods and services. That's more GDP, etc., etc. All right. Now, how do we calculate this? All right. We're going to calculate it with this. You can look at this, but really just remember this guy over here, 1 over MPS. All right, if you know MPS is equal to 1 minus MPC. All right, let me continue with this. So 1 over MPS is going to be the spending multiplier, right? MPC and MPS have equal 1, so if you got one, you got the other one. Okay, there we are. So you can have a positive spending multiplier or a negative spending multiplier. It's going to be positive for increasing spending. It'll be negative if we are decreasing spending. So got to pay attention to, is it going up or down, right? So positive multiplier when increasing spending, negative multiplier when we decrease spending. All right, really with the spending and the tax multiplier, you got to ask yourself, are we creating more spending in the economy or less? Okay. The tax multiplier happens when the government is going to raise or lower taxes. All right. So if you increase taxes, you're taking money out of the circular flow. All right. And therefore, people don't have as much money to spend on goods and services, which means you decrease overall spending in the economy. And that's if we raise taxes. If we decrease taxes, we're leaving more money in the economy in that circular flow, which means more goods and services can be produced. Okay. So the tax multiplier, if we're raising taxes, it's going to be negative. If we lower taxes, this multiplier will be positive. All right. So pay attention to this one over here. All right. Negative MPC over MPS, right? When we're raising taxes anyway. So remember the MPS is always in the denominator. All right. With spending multiplier, it's 1 over MPS. With tax multiplier, it's MPC over MPS. Negative if we're raising taxes. Positive if we're lowering taxes. Yep. So like it says there, tax cut, multiplier is positive. Tax hike, multiplier is going to be negative. All right, so let's run through a few examples and see how this works. So in this example right here, assume U.S. citizens spend 90 cents for every extra dollar they earn. Further assume that the real interest rate decreases, causing a $50 billion increase in gross private investment, that's IG, and C plus IG plus G plus XN. Calculate the effect, of a $50 billion increase in aggregate demand, or in IG on U.S. aggregate demand. So the first thing we got to figure out, they're giving me dirty looks, so I told them to be quiet, because I'm trying to finish recording this. All right, so step 1, you want to calculate the MPC and the MPS. All right, now the MPC in this case is going to be 0.9. How do we know this? Because the question says for every extra $1 that people earn, they spend 90 cents of it. So that's 90 cents out of every dollar, 0.9, which also means the MPS is therefore 0.1. All right. So step 2, determine which multiplier to use and whether it's going to be positive or negative. Okay, so in this situation right here, we know it's going to be a positive multiplier, and it's going to be a spending multiplier, because we're talking about increasing spending, all right, gross private investment, so spending is increasing. So we're using spending multiplier, and it's going to be a positive multiplier. Step 3, calculate the spending and or tax multiplier. So we're going to calculate this multiplier. You remember that the spending multiplier is equal to 1 over MPS. In this case, that's 1 over 0.1, which gives you 10. So a multiplier of 10. And then we take 10 times the initial change in spending. So the initial change in spending was $50 billion. We multiply that by 10, and we get ourselves $500 billion in aggregate demand. Okay, so that initial change in spending of only $50 billion increased aggregate demand potentially by up to $500 billion. So this is the multiplier effect. You have greater change in aggregate demand and GDP than we saw with that initial change in spending. All right. Another example. Assume Germany raises taxes on citizens by 200 billion euros. Furthermore, assume that Germans save 25% of the change in their disposable income. Calculate the effect of the 200 billion euro change in taxes on the German economy. Go through the same process again. First of all, what are the MPC and the MPS? Well, here we see that Germans save 25% of their change in disposable income, so that means the MPS would be 0.25, right? And therefore the MPC has to be 0.75 because they got to equal 1. So MPS 0.25, MPC 0.75. Next thing, which multiplier are we going to use? Well, we're talking about taxes here, raising taxes, so it's going to be a tax multiplier. And since we're raising taxes and taking money out of the economy, out of that circular flow, it will therefore be negative. So a negative tax multiplier. Step 3, let's calculate that multiplier. The tax multiplier is equal to negative MPC over MPS, which is therefore negative 0.75 over 0.25, which gives you a multiplier of negative 3. So step 4, we take that multiplier and we multiply it by the change in the initial change in taxes. So you have negative 3 times 200 billion euros, which gives us negative 600 billion euros. All right. So aggregate demand will decrease by 600 billion euros. All right. GDP will decrease by that. See how this works? Last example. Assume the Japanese spend 4/5 of their disposable income. Furthermore, assume that the Japanese government increases its spending by 50 trillion yen, and in order to maintain a balanced budget, simultaneously increases taxes by 50 trillion yen. Calculate the effect of the 50 trillion yen change in government spending and 50 trillion yen change in taxes on Japanese aggregate demand. All right, calculate the MPC and the MPS. MPC, it says they spend 4/5 of their disposable income. Picture this being additional. So that'd be 0.8. If the MPC is 0.8, then you know the MPC has to be 0.2. All right. Determine if we're going to use tax multiplier or spending multiplier. Well, we're actually going to use both this time because the government is going to increase spending by 50 trillion yen. And in order to maintain a balanced budget, we'll also increase taxes by that amount. So we're doing both at the same time. The spending multiplier will be positive because we're increasing spending, and the tax multiplier will be negative because we're increasing taxes. Okay, so we got both, which means we're going to calculate both. Spending multiplier is equal to 1 over MPS. In this case, that's 1 over 0.2, which gives you 5. The tax multiplier is negative MPC over MPS, which is negative 0.8 over 0.2, which gives you negative 4. And then we apply them in the calculations. So, change in government spending was 50 trillion yen, right here, times the spending multiplier of 5. Right, and then we also have the 50 trillion yen increase in taxes times the tax multiplier of negative 4. So the change in spending resulted in 250 trillion yen increase, right? That'd be the 50 trillion yen times 5. And then we had a negative 20 trillion yen decrease, right? Because you had the 50 trillion yen times negative 4. So add those two together, 250 trillion yen increase minus a 200 trillion yen decrease. That nets out to 50 trillion yen overall change in aggregate demand. All right. Now, this is a little situation we call the balanced budget multiplier. All right. So it's a little bit of a pain to go through, but the balanced budget multiplier is 1. Really what we're saying here is that if we increase taxes and spending by equal amounts, the end result is going to be whatever the initial change in spending was. So you don't even have to go through all those calculations, right? So if you increase spending by a certain amount and then you increase taxes by the exact same amount, the net result will be whatever that initial change in spending was, all right? So we want to try to bear this in mind, and it will make things a lot easier when you look at some of these questions also. Sometimes I'll ask a question where they don't even give you numbers. They'll just say, well, we increase spending and then we increase taxes by the same amount. What will happen to a GDP? And the answer is GDP will still increase, okay, because the spending multiplier was always going to be bigger than what the tax multiplier is. All right, I'll actually look at that here in just a second. So what I have here on this screen is going to be popular MPC and MPS combinations that AP Macro likes to use, right? So a lot of times they'll use these sets, right? 0.9 and 0.1, 0.8 and 0.2, 0.75, 0.25. Why do they use those? Well, it makes it really easy to calculate the multipliers, all right? So if spending multiplier, right, is going to be 1 over MPS, so it's 1 over 0.1 gives you 10, right? Tax multiplier is negative MPC over 0.1. So you got 0.9, negative 0.9 over 0.1 gives you a tax multiplier of negative 9, right? If you look at each one of these are really easy to use. Every once in a while you might even see like 2/3 and 1/3 because that could be easy to calculate as well, right? But what you see here is that when you have these combinations, spending multiplier is 10, tax multiplier is negative 9. Spending multiplier is 5, tax multiplier is negative 4. Spending multiplier is 4, tax multiplier is negative 3. So again, if you increase spending and taxes by equal amounts, you're going to get a positive multiplier of 1, right? That once you do all the calculations and net it out, spending will still increase, and it will increase by whatever the initial change in spending was, all right? So remember that, it'll make it a whole lot easier, and we're going to practice some with this on an assignment.